Hello and welcome to today's KraneShares webinar, Magnifying Exposure, Emerging Markets AI, an Internet Update with a deep dive on the KraneShares Single Stock Suite. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. I'm joined today with my colleague, investment strategist, and a key component of our China Internet coverage, Henry Green. Henry and I are looking forward to providing an update on some of the trends we're seeing within China's as well as emerging markets, technology and internet, and then talk about some specific opportunities around single companies that we think are capitalizing on this opportunity. Certainly for those who would like to receive the deck or have questions, please email us at info@kraneshares.com. Or for those of you joining us via the web, via Zoom, please use the Q&A function. For those of you who would like to receive either CFP or SEMA continuing education credits, please email us at ce@kraneshares.com. That's Charlie Edward @kraneshares.com. Very quickly, for those of you less familiar with KraneShares, our firm was founded in 2013 based on the experience of our founder, Jonathan Crane's experience and time living in China, where he built a successful business geared to China's growing urban middle class. While living in Shanghai, Jonathan experienced firsthand the adoption of mobile technologies as well as the effect of continued urbanization on China's economy as well as its capital markets. Jonathan also arriving in China in 2001 actually was when the first foreign investor was allowed to invest in the onshore, that is the Shanghai and Shenzhen stock exchanges. When Jonathan ultimately sold his China business and moved back to the United States, he was taken aback by the rapid rise of exchange traded funds in the United States. However, when he looked at the China ETFs, as well as China's exposure in broad emerging markets, it was all old China economic sectors. It had nothing to do with the trends that he experienced firsthand while living in China, that the growth of new China economic sectors such as internet, healthcare, clean energy were really the new drivers of China's economy. They had little to no exposure in China nor emerging market ETFs. Additionally, the definition of China was only offshore China, that is, Chinese companies listed in Hong Kong. That set about Jonathan's thesis on creating KraneShares, a China-focused ETF provider with an emphasis on new China economic sectors. On the next slide, you'll see that we've evolved our business beyond China. Yes, we are very well known for KWEB, our China Internet ETF, as well as other growth opportunities in China, such as healthcare and clean technology. At the same time, we've taken trends that we've seen happening in China and applied it to broader emerging markets like KEMQ, our EM version of KWEB, as well as trends like the rapid rise of electric vehicles in China that we saw back in 2017 as being a global trend, where we listed our global electric vehicle ETF. We've also pioneered the carbon credit allowance futures trading space, those efforts led by our colleague Luke Oliver, as well as we've worked with partners such as Nancy Davis of Quadratic Capital to launch the iVol ETF, Man Group on our bio, are basically applying private equity buyout to public markets, as well as our good friends at Mount Lucas, who have been running managed futures strategies for several decades, and that led to the launch of KMLM. Okay, so let's dive in. I think first and foremost, one of the things that that we've done is pioneered new efforts around single stock ETFs. And single stock ETFs really are focused on a single company that then applies a leverage. So you're actually getting, say, twice the intraday performance of that underlying security. Now there's pros and cons to every strategy. The positive here is we don't have to open up a margin account or a derivatives account. Now we're able to get the twice the exposure on an intraday basis. The one caveat with these strategies is that a real emphasis on this twice the intraday exposure. So over a multitude of days, these products are considered path dependent. So the return over a month is not day one to day 30. It's really the accumulation effect of that daily twice the performance. So it's one of the major potential risk factors, or one of the considerations is this path dependency based on that leverage. Now, in the next slide, how the process works is like, yes, we could go in ourselves here at KraneShares and provide twice that exposure, but that would be have a very significant tax consequence. So our single stock ETFs are utilizing a swap. So we enter into an agreement with an investment bank who provides us, they're entering an agreement with us, a contractual agreement to give us twice that intraday performance. And that way, we here at KraneShares don't have to trade the underlying on a daily basis. That investment bank is providing us that exposure via a swap, and therefore we don't have a significant capital gain negative effect based on that daily trading necessity that our contractual agreement is with based on the swap. So there's a little bit of a benefit from a tax efficiency basis to utilize this swap structure rather than actually doing it ourselves and having to trade it on an intraday basis. So there's a little bit of a benefit from a tax efficiency basis. On the next slide, where we've put our focus is on a number of companies that we've really gotten to know through owning them through KWEB. And then we've actually, so you have a number of KWEB's major holdings, companies like Baidu, JD, Alibaba, and Pinduoduo. That same time through KEMQ, the EM version of KWEB, we've really gotten to know a company called Mercado Libre, the proverbial Amazon of South America. And Henry's going to do a deep dive on a little bit of the opportunities we see with these five companies, why we actually chose these five companies. But on the next slide, I think one of the things we really want to stress is that a big element of our efforts here at KraneShares is our research efforts, and that really, you see a lot of that with KWEB, our focus on our China internet strategy, the largest China ETF here in the United States. At the same time, we've applied that China thesis to broader emerging markets, and really KEMQ just applies the KWEB thesis to broad emerging markets. And we really think it's a great strategy, self-serving and highly biased, but we think it's a great way to get growth exposure within emerging markets. And a big reason for that on the next slide is you'll see that a lot of times when we're thinking about emerging markets and why we want to invest there, it's because of a lot of the trends we're seeing in terms of the growth of the middle class, the growth of domestic consumption. In many countries within broad emerging markets, particularly, let's say, like in India or in South America, you have very favorable demographic trends. But it's really about trying to provide that exposure in KWEB and KEMQ to these trends. Now, the issue that we've noticed, obviously, is that within the definition of not just say China, but also within emerging markets, is that in a lot of these countries' stock market, they're really dominated by financial and energy companies. And that's just the nature of that local economy and which companies went public first. But we see that the disparity between GDP growth as well as GDP per capita growth has nothing to do with the performance of these indices because of the sector composition of the underlying index. So let's prove that mathematically. We're data junkies here at KraneShares. And so, we're not buyers in hyperbole and exaggeration, but let's prove out that thesis. So on the next slide, many of us are aware that since the global financial crisis low, the S&P 500 is up 1,286%. Now, in general, non-US equities have underperformed. So if we look at a broad definition of non-US equities, that'd be the MSCI All Country World Index ex-US. It's only up 373%. Holy cow. Now, I think you have to realize after 16 years, that's 64 quarters. I think many investors have kicked those non-US investments to the curb, but we think the real culprit here is the definition of those indices. And in the case of China, yes, MSCI China is only up 265%. But if we just pulled out, say, a growth sector such as technology, it went up. MSCI China Technology is up 3,229%. We actually did more than double the performance of the S&P 500, but only holding a small percentage of that broad definition of China. And as this slide demonstrates, the exact same issue is true with broad emerging markets. Holy cow, look at this. Look at the underperformance of MSCI emerging markets versus just pulling out the consumer technology companies. Now, and again, this is exactly why we listed KWEB back in 2013 and about 7 years ago listed KEMQ, is to give you this growth factor to eliminate financials, energy, these slow, no growth sectors from your exposure, give you that growth factor. And that's exactly why on the next slide, we're very focused on these growth companies. And really, we've seen that through our study of China. Now, we know there's a whole host of great growth companies that we hold in KWEB, but certainly through the process of understanding these companies, we've gotten to know great companies like Mercado Libre, which is very focused on Latin America, as well as companies like Naver. Obviously, everyone has heard about TSMC. Can't not read about TSMC. That big holding in KEMQ. But there's a whole host of great growth companies that are outside of the US. It's just historically, again, these have been small percentages of the broad indices, why we've listed these very specific funds like a KWEB and a KEMQ. On the next slide, our thesis around this was really that in China, this is your primary source of entertainment. I always say, like, the way to prove when I'm in China, the way I can prove that I'm American is because I carry around one of these, a wallet. Because the things that are in here, an ATM debit card, credit card, these are things that are irrelevant in China today because of the adoption of mobile payments. But this is more than just a wallet in China. It's your primary source of entertainment. It's you have these super apps and the Chinese citizens have adopted the mobile phone in a very, very significant fashion. And we've seen this really tremendous uptake in the growth of Chinese internet companies that we hold within KWEB. This was really one of the original thesis of Jonathan Crane in forming KraneShares back in in 2013 when we listed KWEB. On the next slide, where we see the puck going is actually with the growth of new beyond internet. We see new opportunities, and these opportunities are certainly not just China specific. These are going to be global trends, but we really do see many of the leading companies within KWEB, their business models continue to evolve. Specifically, Alibaba, their cloud computing. I mean, Alibaba's become really arguably the number one cloud play in China. We've seen Baidu very wisely took their profits as the proverbial Google of China and really applying that to new areas like autonomous vehicles as well as cloud. But again, we think because of this incredible outperformance of U.S. stocks that there's a significant home bias, and I don't think a little bit of out of sight, out of mind, some of these opportunities maybe aren't as specific to investors here in the U.S., which is really why we wanted to kind of share some of these insights. On the next slide, where we see a real opportunity for particularly KWEB and KEMQ is within the cloud computing. I think this just really demonstratively shows that the companies within KWEB have become quasi AI plays, but as you saw from the previous slide, they're trading at very steep discounts to their US equivalents. And again, that's part of the opportunity we see is really the opportunity of taking advantage of a real trend here in the U.S. equity market, which is obviously AI, but doing it at a significant valuation discount. And yeah, I just think this opportunity is only going to grow in the years to come. On the next slide. One of the areas of why we still believe that the AI opportunity set in China has not really been fully recognized is we hear a lot about uranium and nuclear in the U.S., but China, because of a very significant investment in renewable energy, electricity costs are very low in China on a relative basis. In China, not just solar, wind, but hydro as well as nuclear, accounting for 50% of electricity in China today. And we really believe that this cheap renewable energy is going to be a significant driver of AI adoption and cloud computing adoption within China. And if anything, some of the issues with AI adoption in the US as well as Europe is going to be the issues around electricity consumption and the potential high cost that could be passed along to retail consumers based on data centers, strong demand for electricity. Again, we really are big believers in the China clean energy space as an AI play, something that I don't think the market really recognizes today. On the next slide, this is a great opportunity, on a quarterly basis. Henry does a great job. If you're not familiar with our quarterly internet report, it's a must read, and really Henry does a really great job in steering that effort. And it's so great to have Henry joining us today because again, he's such a critical part of our research efforts, which is such a critical part of KraneShares. We endeavor to earn the trust of investors through our data-driven research. And Henry, I know Alibaba, it's a company that you and I have gotten to know really well.
Yep.
We always get treated to a nice dinner when we meet our friends at Alibaba in Hong Kong. And
For sure.
I think when when many of us, when we think about Alibaba, we think about the China e-commerce space, but the company's really evolved. And I'll maybe hand things off because I think it's great, great to give an overview of how the company's evolved over time and the various businesses within that broad umbrella called Alibaba.
Yeah, thank you, Brendan. I'm glad you brought up the China Internet Report because every quarter the past few years we've done a subsector analysis, and a few of these companies, especially Alibaba, have become more and more difficult to put into a single box. As you could see, the Alibaba's just has so many hands and so many different types of businesses, and they're not the only one. You could say the same for Baidu. JD a little bit, certainly Tencent has been the case for a while, and just more and more, right, as these companies develop. So that's been something really, really fascinating to watch happen. Here in Alibaba, right, so this is a classic kind of map we drew of overview, so to speak, flyover of the various businesses in the Alibaba ecosystem. So you have domestic e-commerce, that's Tmall. Tmall is verified merchants, but they also have Taobao, which is a little bit more like eBay, a little bit more peer-to-peer. And then they have Lazada, which is international e-commerce in Southeast Asia. Cainiao, logistics. They even have a small media platform, Youku. And they also have Ele.me, which is food delivery and local services, competing directly, of course, with Meituan, which we know very well for its food delivery services. And then they also have Ant Group, which has kind of been a little bit forgotten about recently, but they still own 33% of Ant Group, and Ant Group is still a payments powerhouse in China. And then finally, the big boy, which has been growing so much recently and has really been in focus recently, is cloud and AI. So that's Alibaba Cloud paired with their Tongyi Qwen AI large language model chatbot. So that's your ChatGPT from Alibaba, right? And they see about 7 million monthly active users, but they're really focused on the enterprise. We're working on businesses, an enterprise model, and the chatbot itself is totally free. They see the monetization by having the chatbot drive cloud use. Right, so that's kind of a little flyover of Alibaba's current businesses. And then, so if we go to the next slide, I think we have, yeah. So this is just looking at Alibaba's growth over the years. So 2014, right up until 2021, 2022, we see really fantastic revenue growth. I mean, certainly outpacing its U.S. counterpart, its closest U.S. counterpart, Amazon, quite significantly. I mean, we had years like 2017, 2018, where you have 50, 60% revenue growth, okay? And then and granted, it did slow, kind of going into the early 2020s. And so why is that? I mean, part of the reason is, quite frankly, Alibaba was able to operate what was a very, what some people called a bit of a monopolistic business practice, which has now changed, due to certain regulations, and so that did lower their overall revenue growth rate. But we still see strong, healthy growth coming back, especially 2024, where they're really kind of right on par with Amazon, right? So they no longer have these kind of exclusive merchant agreements, but we've seen this really been actually good for the company. The focus more on innovation, more on really, strong competition in the space. And they've been able to grow still quite healthily. And then also with a strong margin. So margin come down a little bit, but we still see them in 2024 still at a higher margin, a net margin than Amazon, which is due to a couple reasons. They've just really, I think cloud had to do with that, although cloud is not the most profitable part of the business. So there's been a lot of moving parts to this business over the years. And then on the next slide, I think we talk about their most recent quarter, which was great. So overall revenue beat estimates quite significantly. And it was driven by, what was it driven by? Cloud. So cloud was up 34%. Revenue growth overall year over year was only up 5. So really, cloud and AI services are driving this company's growth right now. And we see that a lot in the internet space right now. What's happened is not only, so number one, the reason this is happening is that these companies are innovating, okay? These are some of the best models out there in the marketplace. Alibaba's Qwen, we learned recently, is actually being used, among others, by Airbnb, by the US platform, is actually choosing to use Alibaba's Qwen large language model for its AI-enabled services and speaking with and working with its clients. Because they said because it's so very customizable and it's more customizable than others. So Alibaba's really been able to differentiate itself in this space, in the AI space, and we see that leading to growth, and that's where most of their growth is coming from now. Granted, though, the other issue, the other reason why it's really the growth in cloud services as opposed to the general e-commerce is that you've seen kind of this. We have a lot of high spending consumers. We have a lot of urban consumers who are really hooked on e-commerce. But we've seen kind of the overall pie for a while. We had the overall pie growing in China, and we've seen that overall pie kind of take a breather. And where really what's happened now is they're getting the same kind of group of consumers, the same wallets, so to speak, just to spend more on their platform versus others, right? And that plays into, which we'll talk about later, what's been going on with this extreme competition in specifically in instant commerce. But we'll talk about that a little bit later on when we get to JD. One more note on just looking at Alibaba's Qwen model, right, versus others, and in consideration for how it can grow. It actually only has 7 million monthly active users. So a lot of those are enterprises. A lot of those are very high value for Alibaba, but it's still lower than DeepSeek, which has 70 million, and actually the most used model in China is actually from Douyin, which is ByteDance in China, which is TikTok in China. They also have a chatbot that's widely the most used. But Qwen is very enterprise focused, so it's really driving that cloud revenue growth for Alibaba. And then maybe let's move to the next slide. I think we have PDD. Yeah, so PDD is another really important name to know in the China internet space. So PDD has got basically they're purely focused on commerce. They have not gone into cloud services. They've not gone into AI. They are, although I would suspect that they're using AI to optimize their own business, but they have not offered a chatbot. They're not engaged in that. But they were really strong. So they started by being Pinduoduo, which literally in Chinese means together more, which was kind of a Groupon. If you remember Groupon, kind of like literally people would form teams, shopping teams, and get together and say, hey, we all want to buy this product. Can we buy it in bulk and bulk up the quantity to lower the price? And this was just a great platform for people to do that. And it really made a name for itself in this kind of discount retail e-commerce area. And they took that model, not necessarily the group buying model, but they found that they had a really good, engaging application that not only was able to source things at a very low price, but it was also able to keep users engaged and really make it easy for people to kind of buy things and find things they were interested in. And they brought that internationally with Temu. Some of you who are in the US or Europe might have used Temu on your phone. And, if you get things for really cheap and it takes really long for them to arrive. But that's a business model. And it's another option for consumers globally that's really taken off in recent years. Let's move on to the next slide. Yeah, so again, you have this really incredible revenue growth going into. I mean, this is 2018 is kind of putting things out of whack here, but if you look at 2020, 2021, they're still growing 100%, 50% growth. So this was like the #1 growth performer in terms of revenue in China internet space that we looked at for the past couple years. And that was really driven by this, not only the domestic commerce, but also this international brand that they built with Temu. And they struggled with profitability, but they are now profitable since 2022. Let's move on to the next slide. So in their latest quarter, they beat estimates, but estimates, I will say, were pretty low. Just because so we estimate they receive about 15% of their revenue from US shipments, and obviously with the trade tension and the revoking of the de minimis rule, right, that was causing some headwinds for their revenue growth. So estimates were pretty low, but they ended up beating them, and then they kind of avoided the worst outcome here. We do see the stock on the right dipping significantly in October, coming back in November a little bit.
I guess one of the challenges also, Henry, is it's just kind of an interesting phenomenon with PDD where they've never specifically broken out the Temu from the China e-commerce. So it you kind of understand there's a little volatility, just analysts who cover the name, even ourselves, you can kind of guesstimate what you think that is, but the company historically hasn't provided that transparency, which is obviously it's their right, but probably explains a little bit of some of the volatility here.
Yeah, definitely. And this estimate is from an internet scraping firm that looks at just kind of online traffic to Temu versus others. And so, yes, it's very much an estimate, and it should be taken with a grain of salt. But yeah, the company doesn't break that out. So anyway, that does make it challenging to analyze this company. And then I think on the next slide, we're going to look at Mercado Libre. So moving our ship, so to speak, to Latin America, we have Mercado Libre, which is, if you don't know Mercado Libre, you should know Mercado Libre. They're really important in Latin American e-commerce. They are the #1 platform, #1 name in Latin America for e-commerce. Obviously, you got Amazon, you got Walmart in that market too, but they're the local player. They're in a lot of different countries. They're in Mexico, Brazil, Argentina, and more, and they keep expanding the new countries and new markets. They also had a very positive third quarter. They saw strong growth in loan growth on their Mercado Pago, which is a payments platform, in the third quarter. That was a key highlight. Revenue overall grew about 40% year over year in the third quarter, which was very positive, adding 7 million users. They built more fulfillment centers in Argentina, and kind of dealing with a little bit of the political volatility there. And that's actually interesting, and one of the reasons that I think this stock has had so much volatility and in recent years is because it's very much associated, rightly or wrongly, with Argentina. I think at one point their domicile was in Argentina. It might still be.
And they actually moved it to Uruguay.
Yeah, Uruguay, yeah. And so that's caused a lot of volatility in this stock. I think if you look at this latest dip, I think it's right around the time of the election, Milei getting reelected.
Mm.
So we see it pop back when Milei got reelected. Obviously, he's certainly done a lot to transform Argentina's economy. And on their earnings call, they talk about it, and they say, we're very positive on what the current Argentinian government is doing and continuing to develop the business in that country.
Yeah. I mean, I know, there's been a lot of chatter too around, is Amazon going to enter, what are their plans, and particularly in Brazil, and that competitive threat, kind of comes and
Yep.
goes. I still think potentially, that this is a potential buyout play. I really think
Yeah.
an Amazon, potentially a Walmart. It's
Yeah.
just a really interesting opportunity to yeah, this is pure speculation, but to take advantage of a great company, great infrastructure, a lot of local knowledge in place, ready to go, and um, that only time will tell if that thesis proves out. But it's an interesting, I think, a very interesting company from that perspective alone.
Yeah, for sure. And I think on the next slide we got JD up next. Yeah. So JD, all right. JD has been in the space a long time. JD is known for, in comparison to Alibaba, in comparison to PDD, they're known for larger items, computers, appliances, things of that nature. And that's been kind of their bread and butter business for a long time. And that's resulted in a slightly different business model over the years from Alibaba. They have always had lower margins than Alibaba. There's more costs involved with the types of products they're selling and shipping around. But so last year, they made the decision to go into the food delivery business and the instant commerce business, where, for those of you who don't know, that is where you can pick up your phone, order something online, and have it arrive within the hour. This is something that I think only certain areas, even here in the United States, have available, and likely at a great expense. I have not tried to do something like this here. But I do know my colleagues have done it in China with Meituan and said, yeah, I needed like a pair of socks, because mine, I used mine and I got it delivered to the hotel in like 30 minutes to an hour. So it's really this phenomenon that's taken off in China recently. And so if you remember what I mentioned about why most of Alibaba's growth has been coming from cloud, it's also because, really what's happening right now, just with, real estate starting to come back, we still have that negative wealth effect going on, right? Unfortunately, right now in e-commerce specifically, these companies are really competing for the same wallets in these urban markets. And so instant commerce and that faster, the more promotions and how fast you can get the item to these consumers is really important in the name of the game right now, to get these same wallets to spend this platform or the other. And JD going in, and I'll say, I think JD going into this space was like a comet hitting this whole industry. Everybody said, "Whoa, what is going on? What are you doing, JD? This is not your bread and butter." Alibaba did it a little bit. Meituan is what's known for this and been doing it for a long time. And so JD is spending a lot to do this. And I mean, they're doing well at it, right? Actually, in the third quarter, you look at their revenue specifically from local services, so that's both instant commerce for goods and food delivery, tripled year over year. So they've been successful at this, but nonetheless, it's been costly, and you see that reflected in their margins. And they're causing other companies to spend more to defend their market share, like Meituan. Meituan came up short of estimates in the third quarter, and that was mainly due to high spending to match all of these promotions that JD is doing, and Alibaba to some extent has done, but they're not as much involved here. So that's been a headwind for JD. But it's also an opportunity. I mean, their management is kind of playing a dangerous game here. They're saying we can make real strides in this and we can gain market share here, and this will play out for the long term, even if it's costly now. Will it be successful? It's anyone's guess, but that's just a reflection of how kind of dynamic I think this China internet space continues to be, and how many opportunities there are for kind of opportunistic trading if people are so inclined. And then maybe move on to the next slide, I think is our final company today, Baidu. So Baidu is the Google of China. It's been known as that for a long time. It's the search engine. It's search engine historically that everybody's gone to. And so, but with AI, and this is the case here in the US, but it's especially the case in China, with the advent of AI has really moved that volume of search from traditional search to chat-based search. And that's really hurt, even though Baidu has its own Ernie Bot chatbot, it has really hurt their revenue. Most of their advertising revenue comes from this traditional search business, and they're just not seeing the same volume anymore. They had a 1-2 punch of a slowing economy, and now even though the economy is coming back, people are going to AI. They're going to chatbots to search, not traditional search, and that's been really difficult for the company. But the upside for Alibaba is their other businesses, okay? Like Google, they're involved. They have, like I mentioned, they have their Ernie Bot chatbot large language model, and they also have actually one of the world's largest, I think by fleet size, it is the largest robotaxi business, and they've expanded this internationally. They're in many cities in China already, some of which are already breaking even, might actually be profitable soon. And so they're really doing well in that business, but that doesn't make all that much money yet. And then they also have cloud. Like Alibaba, they're competing directly with Alibaba, probably number 2 or number 3, depending on what you kind of look at, with Tencent also in the mix on cloud. So Baidu has a lot of promise. And one of the issues that we've actually I think we've brought up, Brendan, to the company directly, is they have a lot of cash on hands and they're not using it for investments, so it would seem. I mean, and that you can see that reflected here. Their cash as a percent of market cap is 43%, which, you know, we know some companies, actually. I think PDD has a lot of cash too. But then as a percentage of market cap, though, for Baidu, it's almost half, right? So it's kind of like, what are they going to do with this cash? And at the same time, of course, if you look at their PE ratio, like a lot in the internet space, it's much lower than what you see in its US counterpart.
Yeah, I mean, I thought from the last earnings, management kind of alluded that, maybe they would try to, implement some shareholder-friendly strategies that,
Yeah.
buyback, dividend, potentially some spin-offs. The proverbial sum of the parts analysis is, you'd argue the company is grossly undervalued. I mean, yes, that to your point, that core search business is pressured by the growth of large language models. Just even myself, like, I don't use Google search as much. I'm maybe using Perplexity. At the same time, I do think we've seen, as you alluded to, this the fall in housing prices. It was kind of weighed on some consumption. Obviously, we see a lot of subsidies from the government to try to support domestic consumption, but that's maybe weighed a little bit on Baidu. Similar to Google. They make a lot of money from advertising, and people aren't buying a lot of stuff. Maybe we don't need to advertise as much. So
Yeah.
Baidu is a very interesting company. I still think, Robin, this is where, in the case of all of the companies, we've been, virtually all the companies, we've been discussing, the founders, either the chairperson or the CEO, and I think Robin Lee is, someone who takes a lot of pride in the company, in Baidu, and
Yeah.
obviously a lot of his net worth's tied up in the security. So yeah,
Mhm.
hopefully 2026 we see some of that shareholder friendliness implemented, and hopefully
Yeah.
unlock some of that stored value that you're speaking to, Henry.
Yeah, I read a sum of the parts analysis for Baidu. Now, this is not our work. This was, I believe, coming from Morgan Stanley. But they did a sum of the parts analysis of the company and said that it indicates a value per share of north of $200. Obviously highly speculative, but that just implies that maybe I think, Brendan, we were discussing, right, could they be a buyout or breakup target as well? It could be maybe in the cards for Baidu, but anyway, it's very hard to say kind of where this company's going, but there's a lot of promise. It's not whatever it is, it's not worth. The market is, I think, having trouble valuing this company one way or the other, right? And we'll see that continue to be reflected in its price action. And I think in the next slide, I think we're all through here. I think on the next slide, yeah. So this is just going over once again our five. Now there are five of them. Our five single stock levered ETFs. We talked about all five of these companies today. And we're always sharing our insights on these names because they are the KWEB names that we know and love, and hope those listening do as well. We're I'd like to say we're very well versed in these names, but obviously there's always new news and new information to digest. And so for KWEB and KMQ too, right? A lot of these are also in KMQ. I see Mercado Libre is only in KMQ. It's not in KWEB because KWEB is only China. And it's one of the top holdings, of course, in KEMQ, which again takes that China internet thesis, broadens it out to emerging markets worldwide. And I think Brendan, we have a little bit of time for questions, right? And I know a couple people have wrote in asking for a copy of this presentation, and we'd be happy to send that over to you if you just give us your email through the Zoom chat, or you can email us at info@KraneShares.com as well.
And certainly for those for SEMA as well as CFP continuing ed credits, if you just email us at info@KraneShares.com, we can get you that hour. So that's Charlie Edward at KraneShares.com. Happy to pass that along, and certainly any questions, please again email us at info@KraneShares.com, and you can put Henry and I to work. It was interesting. I mean, the one thing that I'd point out, in today's ChinaLastNight.com, it didn't make a lot of headlines, but I did notice that SAMR, the State Administration of Market Regulation, so this is really the regulator for the internet companies. They actually put out a release after the markets close, speaking to some of this restaurant delivery war, Henry, and as you pointed out for JD, and it's the real leader in the space historically, Meituan, this price war where they're giving deep discounts. They've been able, to your point, the companies have kept, they've grown their top line, but it's really weighed on their bottom line net income, earnings per share growth, going negative. And that subsequently really weighed on their stock price. So this is the second time we've seen this regulator opine on this restaurant delivery war, and it's really our hope that you see some further time over the next day or two. We'll see if the companies do respond to this announcement from the regulator that's really saying that that this restaurant delivery war, it's potentially not, it's not a good thing. And certainly I think investors in those two companies, we would agree it's not been a very good thing. Obviously for JD, they see it as an opportunity. To your point, they've got their very significant delivery network. Why not put those folks to work on restaurant delivery? And how do you gain market share when you enter a new market? You discount, you give it away. At the same time, that forces Meituan to respond. So I just think big picture, potentially, there's maybe some things that could lead to hopefully a repair of that bottom line for JD
Mhm.
and Meituan.
Yeah. Yeah, and I think I alluded to this, but I think I think a smart strategy, whether it's the government or the market regulators or just from a macro sense, I think if the total pie of e-commerce grows again and we get people more penetration in lower tier cities and more rural areas, right? I think that'll kind of bring the company's attention away from this, where they're again competing for the same wallets, right? And so I think that's going to be a natural consequence, right,
Yeah.
as the economy comes back, but also where more consumption stimulus could also have the impact of lessening of ending lessening this price war. Got a couple questions coming in, Brendan,
Sure.
and so number one is just about the idea of leverage through an ETF, asking, well, why don't I just buy twice as many shares of the stock to get the same impact, right? And I suppose you could do that, but
For
you're not
sure.
getting the effective leverage, which allows you to do more with the same amount of money. Obviously, you would need more to buy more. So I don't know if you have any other.
That's exactly. I mean, obviously, you could buy twice as much. You could also use margin. Your margin has a cost. There's, that you get charged an interest rate. You can also get a margin call. And I think this is part of there's pros and cons. And, I think the nice thing about the levered exposure that we're providing here is, we're doing that legwork on your behalf. We're doing it in by owning this swap. We're able to get some some efficiencies there, both operationally and from a tax perspective. So, yeah, I think this is one of the things that, we kind of recommend investors do some real work. Obviously, I think the big thing is that path dependency, that this is twice the intraday. So yeah. I mean, I think it's another, it's a tool for the toolkit. It doesn't mean it's right for everybody. But again, we think it's, particularly for us and our study of these companies. And I think to your last point, Henry, it's more of as we look out on the horizon, we know we've got the draft of the 15th five-year plan, significant emphasis on technology, self-reliance, government support. That really plays into cloud, EV, right? At the same
Yep.
time, there's a emphasis on domestic consumption, and these companies that we're speaking about are on the China. These are the transmission engines for domestic consumption as it occurs online. So hopefully we get some further articulation. We've got the China Economic Work Conference. I've not seen those dates released, but this is the big year-end economic powwow, government and economic leaders coming together and really further articulating like what
Yep.
is needed. And then, we'll see in, we'll have the big policy meetings, the dual sessions where we'll get that draft of the 15th year plan ratified. But net, you can see a real tailwind coming for these companies. And it's again, I think it's they've been a little bit out of sight, out of mind. We see that reflected in some of these discounted valuations, and net, and then you have a company like Mercado Libre, where
Yep.
obviously the leader in e-commerce in South America. And again, I think it's almost part of this, coming back to non-US equities, where we see a
Yep.
real opportunity with a great growth company.
Yeah, well, I think, Brendan, that goes a long way, part of the way, at least in answering our next question, which is just what are some catalysts to keep EM Tech going, right? After it's had a great year so far in 2025. And I think a lot of that answers the question for China and with Mercado Libre a little bit for Latin America. I would also add with emerging markets, right? The dollar's declining. That tends to be good for emerging markets. We like to talk about if you look at the decade. Obviously, in the last decade, U.S. equities have wildly outperformed broad emerging markets, but not technology, right? But the decade before that, not so much. And you also had a declining dollar, right? So this does have an impact on the broad market. And we're really seeing that shift, kind of regime change in markets here, driven by multiple factors. But I think U.S. dollar is important to remember. And then, in terms of tech, when you talk about EM tech too, at least for in the context of KEMQ, you're also getting hardware a little bit. You're getting chip makers, TSMC, and so that's also additive to the portfolio if you think there's going to be continued demand driven by AI for chips as well. And obviously some more consumer based. And we always talk about the consumer, but that is also a factor here when you look at emerging markets more broadly. And then, okay, so our next question, and probably the last one we'll have time for today, is what made us choose these stocks? Not only to cover today, but also to launch 2X products on them. I mean, my answer would be these are the companies we know best. These are the companies we own in KWEB and KMQ. And some of them didn't have, we've seen 2X ETFs become quite popular among our clients. We figured it just made sense, right? And again, these are names that we're always looking at, that we're trying to provide information on as well. And again, these types of investments, right, you want to be kind of monitoring it ideally every day or every week. And so we can kind of help you do that, in that sense. Brendan, I don't know if you have anything to add to
I
that.
mean, the other factor is, in the case of these, we do hold the US listed sponsored ADR.
Yeah.
And so we're holding, say, BABA. We're not holding 998A. We're not holding the Hong Kong listing. And that's part of, why we've chosen these companies is that one of the US regulations is that it has to be a sponsored ADR. So in the case of Meituan, primary listed in Hong Kong, 9961 off the top of my head, I believe. But they do have a unsponsored ADR, MPGNY. Now part of one of the rules, the unsponsored ADR versus the sponsored ADRs, a sponsored ADR, the company is actually approving this listing. In the case of an unsponsored ADR, there's nothing wrong. It's just the company's not involved. Just a custodial bank is saying, okay, we're going to buy shares of Meituan in Hong Kong and offer a unsponsored exposure to Meituan. Same is true with Tencent, 700 HK primary listing, TCEHY, an unsponsored ADR. Now, just the way the US regulation reads, you're actually not allowed to do a levered ETF off of a unsponsored ADR. So that's a little nuance. I mean, to your point, Henry, we've gotten to know these companies quite well through KWEB and KEMQ. At the same time, this regulatory issue, or not issue, just as good law-abiding citizens,
Yeah.
obviously we have to adhere to U.S. regulatory approval, which is we have to choose a sponsored ADR. And then again, yeah, a lot of questions. Yeah, we'll definitely get this deck out as quickly as possible. And as always, if you wake up tomorrow, have a question, please email us at info@kraneshares.com. Henry, myself, and the entire KraneShares team is always available. So please don't ever hesitate to reach out. And yeah, with that, certainly really appreciate this great overview, Henry. And I know I'm excited. I'm excited for the Q3 internet report. I know it's in the works as we speak. And then again, for those, we've got a great. It's a busy holiday season. We have two great webinars next week. We've got on Wednesday, Fawn from StoneX, our belief, one of the top China internet analysts. It's going to engage on a Q3 internet wrap up. And then on Thursday, we've got Gavcal's China economist Arthur is in New York, and it's going to join us. So a busy holiday season. We got a lot of stocking stuffers, a lot of Hanukkah gifts to give out in terms of our China investment knowledge, and certainly for those of us, if you aren't able to join us next week, certainly wish you and your loved ones a happy holiday season. Thank you.
Thanks. Bye.